from a financial perspective in terms of, making sure that your winery has a good financial plan in place. COVID-19 is unlike any previous crisis. Traditional crisis response and approaches will not be sufficient. It's important to prepare for the worst and be thankful if that does not eventuate. So a wait and see approach, a reactive approach, is really a non-starter. There's a high likelihood that there could be substantial revenue disruption, leading to a potential liquidity crisis for many. The recovery may not be a quick bounce back. You would most likely have to plan for multiple quarters of lower revenue. It's possible that that doesn't happen and things turn out better, but I think, realistically, it's going to be a very slow recovery process. And it's important when you put together a financial strategy that you plan for that type of long-term recovery. Once reopening occurs, and as Val mentioned, the announcement today was very exciting as far as outdoor tasting facilities. It may still take some time for people to feel comfortable, and in terms of being in a public setting and feeling completely safe. So even when the green light is given, there's going to be some hesitancy that some people may have. So it's going to be kind of a longer term process in terms of the full financial recovery, and it's important to keep that perspective. Employees and customers are likely experiencing fear and panic. So that's something to consider just in terms of your staffing and your relationships with your employees and your customers, to give them a sense of comfort that you have a good proactive plan in place. It's important that you appoint a senior, fully dedicated, what I refer to as a COVID-19 war room team that is focused on this issue every day. What I would recommend is that you have key people within your organization that form this team. As the business owner, you would obviously be an important person to lead this team. In addition to that, I would involve your head winemaker, the head of your vineyard operations, your tasting room manager. Your CFO would obviously have a very important role in terms of the financial plan going forward. If you are large enough to have a marketing person, the head of your marketing or sales would also be important. It's kind of like the expression, many hands make light work. So the more people you can assemble within your winery and vineyard to form a proactive team, the better off it's going to be and the easier it's going to be for everyone. As business owners, it's critical for you to be out in front with a planned cascade of possible actions based on which scenarios unfold, likely more aggressive than your team can imagine right now. So having plan A and plan B and a series of contingency plans from a financial standpoint is very important. Customers will change behaviors in non-reversible ways. This is the so-called new normal, perhaps accelerating prior trends. Bold action now can set you up for success through the downturn. An example of that would be, there's been a trend among wineries to have more online sales. And with the concern that some people may have about re-entering public settings from a health and safety standpoint, that online trend may continue in the future. So, just being aware of certain trends that might be accentuated as a result of the impact of the pandemic. Definitely something to keep in mind in terms of having a good financial plan. I'd like to talk about the ways that a business recovery plan can help your winery and vineyard. Focusing on a business recovery plan can help your company to determine the following. Implement processes to more effectively manage your cash flow and complex financial reporting. Restructuring of the balance sheet. I think that's very important. And related to that, I think it's very important that you have a good communication with your commercial banker and lender. It may require what I refer to as out-of-court restructuring. So you're not in a situation where you need to do, like for example, a Chapter 11 bankruptcy reorganization. but it may require you to look at restructuring some of your debt, seeing if you can work with your commercial lender to maybe have a deferral on some debt payments just to help you through this tough time frame. But definitely being proactive and having a good communication with your commercial banker is going to be very important. Having a good recovery plan can help you to reshape business models, revenue sources, and cost structures. It can facilitate with corporate finance in terms of raising additional capital, additional working capital for your winery. It can help you with the implementation of process and technology enhancements. It can refine strategies and organization. Another question is, what documents and insights provide useful starting points for business recovery? One of those is the cash receipts processes, and that involves reviewing a detailed listing of your cash receipts process. This can help you to identify sources of cash receipts to project cash sources, such as collections or cash sales. It can also identify potential areas of weakness to determine if your collection process could be more aggressive or has pricing issues. Related to the issue of pricing is the issue of inventory valuation and good cost accounting on your wine product. It's so important for the health and understanding the financial wherewithal of your organization. And it also helps you to set prices accordingly. So for each vintage, each varietal of wine, you want to have a good handle on your costing to be able to set prices. And it becomes even more important under the current financial condition that we're facing. The other side of that is the cash disbursements processes. This involves reviewing a detailed listing of your cash disbursements. This process can help to determine critical vendors and disbursements, as well as possible accounts payable settlements. It can help you to restructure debt through payment reduction, temporary deferral, or temporary loan covenant suspension. Again, this involves working with your commercial lender. Many times, banks have financial covenants that are in place as a condition for a business loan or a mortgage. It may be a situation in 2020 where you might have a harder time meeting those financial covenants or ratios, and having that discussion with your commercial lender to see maybe if you can have a waiver for this 1 year of those covenants. That would be a helpful discussion to have. Review payroll to reduce non-critical positions and benefits. This has to be balanced with the receipt of the PPP loan funds. One of the main objectives of the PPP loan is to encourage companies to maintain certain payroll levels in terms of headcount and payroll cost. So you want to be careful about any reductions in payroll, because that could adversely affect the ability to get full forgiveness of the PPP loan. We're going to talk about those loans in more detail toward the end of the discussion, as well as some recent developments that occurred today. Financial information. Determine the seasonality of cash flows for a projection schedule. Obviously, the winery and vineyard industry is a very seasonal business, and understanding the details of the seasonality for your particular winery is extremely important. Having good financial information is the best way to make sure that you understand the seasonality and the ups and downs in the cycle of your particular winery. I often say that for winery and business owners, it's good to have internal financial statements at least on a monthly basis. Depending on your size, you may want to have even more frequent access to current financial data. One of the things you want to avoid is waiting until after year end to just only have your annual financial statements for that year. At that point, it's really too late to do anything productive, both from a planning standpoint, from a tax standpoint. So having monthly internal financials is really critical, especially in the situation that we're facing, and having a good plan going forward. Financial ratio analysis can be very important. It can identify the strengths and weaknesses of your winery. It may determine, based on those ratios, if you're either over leveraged or under leveraged, for example, and having good financial data will help you to formulate a good plan. Operations overview. It's important to conduct interviews with operational department heads to identify areas of potential overspending or redundancies in your operations or process improvements. As the business owner, or those of you who are CFOs of your winery, you obviously take the lead in terms of budgeting and planning, but getting good input from other key department heads is so important. For example, having a good discussion with your lead head winemaker is really critical to understanding the costs that are involved in the wine production process. And a lot of times the winemaker is in the best position to understand the costs that are involved and can provide the CFO and the winery owner with the information that's necessary for budgeting and for planning. Talk to your tasting room manager. He or she may be able to provide insights in terms of staffing. You may have a discussion with your tasting room manager, and they may determine that on Tuesdays, that's a particularly slow day, and maybe you're overstaffed in your tasting room. So getting that type of input from each department head within your winery is really critical to good budgeting and good planning. Interviewing your accounting staff can help to assess billing and collection processes and cost accounting processes for wine inventory. Again, the issue of wine inventory and product costing is so important to determine whether or not you're making a profit, and also to determine whether or not you are appropriately setting the correct prices for a given bottle of wine. As part of the financial recovery plan, I think a good place to begin is with a break-even analysis. I like to think of this process of recovery as running a marathon rather than a sprint. It's not a race to be the first person to reopen your tasting room, for example. You want to make sure you do it effectively and in a way that's going to lead to profitability for your winery as you reopen. So I'm going to talk about the break-even analysis in the context of reopening of the tasting rooms, which is obviously very timely given the announcement today of the availability of outdoor tastings. So a break-even analysis may seem like a step back if you're a well-established winery. It may be something you haven't done since you initially opened. It could be, if you opened 20 years ago, it's something you haven't done in a very long time. But I think it's really essential to begin the process of formulating a financial plan for recovery. Just as a quick refresher, a break-even analysis determines the break-even point where sales exactly cover expenses, and you don't make money or lose money. In other words, it's how much product do you need to sell to break even. There are a lot of online calculators that can provide you with a break-even analysis. There's an organization called SCORE, which assists a lot of startup entities, and they actually have a really good online calculator. Their website is score.org. A lot of banks will have online break-even calendars or analysis calculators as well. We have one internally that we use too, and I'd be happy to provide that at the end of the program. In doing the break-even analysis, it's important to have a good handle on the both the fixed costs and the variable costs. Fixed costs are those expenses that are not impacted by how much wine you sell, things like utilities, loan payments, mission-critical labor, and overhead. I like to think of fixed costs as the costs of turning the lights on. So when you open up your tasting room, you flip the switch and turn the lights on. These are costs that are static and that are going to be there regardless of whether you have half a dozen customers for the day or 100. The other types of costs are variable costs. These are expenses that fluctuate based on sales volume, such as the cost of your ingredients, your bottling costs, and wine production labor as well. With the break-even analysis, pre-pandemic, it was a lot easier to come up with the numbers in terms of your fixed costs and your variable costs. As a result of the pandemic, there are some additional factors that have to be considered. One of them is the payroll protection program, the PPP loans. Most of you have probably already received the funds, and you're in that 8-week time frame. And in terms of doing a break-even analysis, you have to see where you are in terms of how much you've expended on payroll. A large portion of the funds from the loans have to be used for payroll purposes. The other smaller percentage can be used for utilities, mortgage interest payment. So those costs that you've been incurring and will continue to incur for the next several weeks are very important to have a good handle on in terms of doing a break-even analysis. Loan payment deferrals. You may be eligible for 6-month deferrals on bank term loans, which can lower your fixed costs during your reopening or allow you to postpone your reopening. This gets back to having that good communication with your commercial banker to see if there's some flexibility in terms of how you structure your loan payments and possibly get some loan deferrals to help you through the roughest point in time as you're trying to reopen fully. Once you have taken a hard look at your fixed costs and determined how much you need to sell to break even, you can then establish a budget for the first month of reopening. I was looking at some wine industry statistics, and I came across one article that indicated that most wineries need to generate between 33% and 50% of historical revenue to break even. So just a statistic to keep in mind. Obviously, it may vary from winery to winery, but as you're putting together your break-even analysis, you may want to keep that range in mind in terms of revenue that you would have to generate. Based on your analysis, you may decide that it makes sense to postpone fully reopening your tasting room. And it may be the news that you don't want to hear, because obviously everyone is urgent to get back in the swing of things as fully and as quickly as possible. But as you do your break-even analysis, you may determine that, you know what, it makes sense to wait until, maybe the beginning of July to fully reopen. That if you reopen too soon, you'd be incurring too many expenses and wouldn't have the corresponding revenue, and you'd actually be losing more money than if you stayed closed for the next several weeks. So my recommendation is to give it a month and then reopen gradually. Reopen your winery tasting room in stages to get a gauge of customers' behavior before investing in the expenses of a full reopening. So I would recommend opening gradually in lockstep with people's gradually increasing comfort levels and buying ability. Human behavior is oftentimes very difficult to predict under normal circumstances, and given the current situation, can be even more difficult to predict. There's going to be a certain segment of the population that's going to be reluctant to be in public settings, and there may be some reluctance for them to be in a close confined area. And so monitoring and keeping a good pulse on behavior of consumers is important to determine how quickly you should reopen. After a month, reassess. If you're able to break even in the first month of a staged reopening, you can then project your monthly break-even point out to a second month, or to a quarter or a 6-month budget with a projected ramp up in revenue as you move to the next stage with increased capacity. I always say that growing customer loyalty is a long-term proposition. 5 years from now, your customers aren't going to remember whether you opened as soon as the government gave you the green light to reopen, or if you waited 2 or 3 weeks to do a full reopening. What they're going to remember is how you reopened. Did you do it in a classy manner? Did you give them a comfort level that it was a safe environment for them to be in a public setting? So those are the things they're going to remember, not that you were the first one to reopen. So just something to keep in mind as you're doing the break-even analysis. Defending against declining revenues. It's important to take a customer-centric view to build trust, loyalty, and market share through and beyond this crisis. Proactively contact all customers to let them know about business continuity and extraordinary actions being taken. Very important to reach out to your existing clients if you have a customer list. Maybe send them an email blast or a flyer just indicating that you're going to be back in business very soon. You're going to ensure the utmost safety. Just to use kind of an anecdotal story with the CPA firm that I'm affiliated with, the pandemic hit right in the middle of our tax season, right in the middle of March. And we decided to very proactively reach out to our clients to let them know that we were still open. We're still going to continue to work on their tax returns. Meetings that might have been scheduled to be in person, we would schedule via Zoom or through a phone conference. But very important just to reach out to them and let them know that we were still open for business. And I think the same applies to the winery industry and your existing customer base, to let them know that you're going to be back in the swing of things and you're taking extra precautions. Issue targeted marketing campaigns directed at the highest risk segments to proactively double down on potential segment customer-specific concerns. Within your customer base, if you are concerned about a certain demographic, take the extra step to reach out to them. A trend that a lot of wineries have is more online sales, maybe less in-person tasting room sales. There may be, certain demographics, perhaps some older customers who prefer the in-person approach. And so reaching out to them and giving them assurance that at a certain point in time, your tasting room will be fully operational will go a long way to securing those customers. Develop a clear pricing strategy to maximize revenue for the short term and long term. Avoid slashing prices indiscriminately, as studies have indicated that this can take over 2 years to fully recover. And that's very important, the issue of pricing of your product. You want to resist the temptation to reduce your prices in the fear that, if you don't, that somehow that will impact demand. And that again gets back to having a good handle on your cost accounting, understand what the total cost is for a particular bottle of wine, and then setting your prices accordingly. In the short and medium term, identify new accelerated revenue opportunities. For example, pushing online as opposed to in-person wine sales, capitalizing on in-demand product offerings. Plan urgent cost takeout to conserve cash. Some things to look at on the cost expense side of things. Freeze hiring plans as relevant. Again, with regard to payroll, you just want to keep in mind the PPP loan requirements for maintaining payroll. But in terms of additional hires, something you want to look at very seriously before you bring on new people, at least in the short term. Cancel all travel or training that is not operationally critical. If it's possible to defer some training, particularly training that involves travel, that's something to look at for 2020. Again, kind of using our accounting firm as an example, a lot of times we'll send our staff off-site, sometimes out of town for training. With the current situation, we're doing more online training this year too. So it's actually has the benefit of saving on travel costs, and it fits in better, given the current situation. Pause furlough contingent workforce. Freeze marketing and advertising, but do so selectively. Just make sure your marketing budget makes sense and that you're getting the most value for your advertising dollars and that you're spending it wisely. Stop non-critical consulting engagements. There are times when consultants can play a very important role in helping to grow your winery, but just, take a second look and make sure that any consulting dollars that you're spending make sense from a cost benefit standpoint. And, it could be that there's still a high value to certain consultants that you're using, But if there's any way to defer that service, maybe until next year, take a look at that as well. Extend payables with suppliers to preserve cash. Maybe something where you want to have a discussion with some suppliers in terms of working out a good payment plan. Postpone major investments. You may have initially had plans to have some type of expansion of your production facility. You may have had plans to purchase large production equipment for either your vineyard or your winery. You may want to take a second look and see if that's something that can be deferred until maybe next year. Another thing to keep in mind with that is that one of the benefits of equipment purchases is the tax write-off in terms of being able to take accelerated tax depreciation. With revenues potentially being lower in 2020, you may not need those additional tax deductions in the current year. So that might be another reason why you might want to defer any large capital investment to the following year. Excess cost position and build longer-term roadmap for cost savings opportunities without cutting muscle. So you just want to make sure that any cost cutting that you're doing makes sense and that you're not cutting the wrong costs. So it really gets back to a cost benefit analysis. For a certain expenditure, what value are you getting out of that particular expenditure? Work with suppliers to conduct a joint assessment of supply risks, including upstream risks in their supply chain, and set up a joint process to monitor. Excuse me. Ramp up or down production efforts to meet changing customer needs. Production in 2020 may not be the same as in prior years. It may not be the status quo. So make sure you're evaluating your production plans for the remainder of the year just to adjust to customer demand. Review planned sales and shipments of wine and develop contingency plans if demand rapidly decelerates. So you want to have several backup plans in place and stay as nimble as possible. Consider adjusting operating hours of tasting rooms or temporary closures, or pushing customers online to address slower traffic and labor shortages. And defer non-essential tasks to free up labor and stay ready for potential further disruption. One of the things you may want to do, particularly with regard to your tasting room, is again, have that discussion with your tasting room manager. See if it makes sense to have a certain level of staffing, or if it makes sense to be open on certain days. Kind of track it by day and see what the activity is. Flex labor is needed to meet an increase or decrease in demand. Consider borrowing staff from less critical roles if needed. Add capacity to certain operational or customer service areas. Consider shifting some tasting room labor to virtual customer service, maintaining inventory online order fulfillment. Again, just kind of look at the trend toward online sales, wine club sales, compare that to the in-room tasting room sales. Play offense, not just defense. Again, have a very proactive approach. That would include reviewing pitfalls and updating supply chain to achieve greater agility and increased capacities. In the case of a persistent low consumer demand, lay out a path to build sustained relative cost advantage. Gets back to cost accounting. Ensure that your balance sheet is robust enough to create a safety net and resilience against future downturns. One of the things I always stress with clients is to maintain a strong balance sheet. And I work with business owners to monitor the amount of owner distributions or draws that they're taking from the company. Very important to have a healthy balance sheet and to not overly distribute to the owners. It's very important from a commercial lending standpoint. A lot of the commercial lenders, the banks, they want to see that there's some equity that you're leaving in the company, in order to approve additional loans going forward. So having that strong balance sheet, very important. Continue sales, marketing, and R&D investments to maintain market share and prepare supply chain for bounce back. Many of the wineries that I work with do quite a bit of research and development activity. Usually my involvement is helping them to claim the research and development tax credit. There's quite a bit of innovation that takes place both on the winemaking side and in terms of the agricultural vineyard side. And R&D is one area where I wouldn't cut back on a lot, because there's a lot of efficiency that can be gained in terms of efficiency to a winemaking process or an agricultural process, or developing a new product variation that can lead to increasing sales. So I think from a cost benefit standpoint, maintaining your R&D activity during this time frame is very critical. Leverage macro trends and winery industry signals to identify the comeback point. Have clear if-then moves identified in advance. So in other words, have different contingency plans in place to be able to react accordingly. Learn from this crisis to build the resilience muscle for external shocks and plan for and leverage sustainable shifts in customer behavior. It gets back to the expression, what doesn't kill you makes you stronger. And so as a result of this pandemic and some of the changes and some of the adjusting to the new normal, hopefully that will make your winery stronger from a financial perspective. So the next time there's an economic downturn or some type of crisis, you'll be better equipped to handle it going forward. The last area that I wanted to cover was with regard to PPP loan forgiveness. There was actually legislation that was passed by the Senate today that is expected to be signed by the President that makes some adjustments to the PPP loan. I'm going to discuss those. This is actually literally hot off the press. So some of the slides contain the rules that were in effect prior to this legislation that was passed today. But what I can do after the program is I can forward to Val an update briefing that will have some of the changes brought about by the legislation. And I'll discuss them here today, but definitely very timely topic. So accounting for your PPP loan to maximize loan forgiveness. I'm assuming that probably a large portion of you have applied for and received the PPP loan proceeds. It's very critical that you track the total eligible costs that were incurred and paid during the 8-week period following the loan funding. And actually, one of the changes brought about by the legislation is it gives a loan recipient the option to extend that 8-week time frame out to 24 weeks. If you want to keep the 8-week time frame, you can do that. But if you want to extend it to 24 weeks, you're going to be given that option. So it would give you more time to make the necessary expenditures for payroll and some of the other costs that qualify. So there are a series of qualifying costs that must be tracked and thoroughly accounted for. The biggest is payroll costs. And prior to the legislation, at least 75% of the loan proceeds had to go toward payroll costs during that 8-week time frame. What the new legislation says is it drops that percentage from 75% down to 60%. But the caveat is that it creates a cliff. And if the loan proceeds are not used at least 60% to cover payroll costs, then the entire amount of the loan is not forgiven and it becomes a loan. So it's a lower threshold from 75% down to 60%, but if you don't meet that 60% threshold, it becomes a regular loan instead of essentially a tax-free grant. In terms of the payroll costs that qualify, it would include compensation to employees, including wages and commissions, cash tips or the equivalent, payment for leave, allowance for separation or dismissal, payment for employee benefits, group health coverage, so the employer portion that the employer pays for, insurance premiums, Retirement plan contributions, that would be like an employer matching portion. Payments of state and local taxes assessed on wages. There was some guidance that was issued about 2 weeks ago that clarified that bonuses and hazard pay that were paid within that 8-week time frame would also qualify. That had been an uncertain area where, you know, if you were a business owner and you wanted to pay your employees a bonus during this time frame, would that count to get you to the threshold? It has been clarified that that would count. So any bonus payments that maybe you would wait until the end of the year to make, if you wanted to accelerate those, that would help you to get to that threshold, which had been 75%, is now 60%. The other portion of the loan proceeds, which had been 25%, but now it's 40%. The other portion of the loan proceeds can be used to pay mortgage interest on real or personal property for mortgages that were in effect prior to February 15th of 2020. Rent under a leasing agreement for agreements in effect prior to February 15th of 2020. Utilities, including the payment for electricity, gas, water, transportation, telephone or internet access. And again, there's that same date of February 15th, so the service has to be established prior to that date. You know, one thing with regard to rent payments, for example, if you wanted to prepay some rent to try to get to that threshold so that you're using all your loan proceeds within the time period for eligible costs, that would be something you could do just to make sure you're getting to that threshold. Independent contractors do not count. So anyone that you would issue a 1099 miscellaneous to, they would not count for purposes of payroll. Many payroll service providers have developed PPP loan compliant reports and spreadsheets to track both payroll and benefits. There's actually the SBA has come out with a formal loan forgiveness application that has to be completed and submitted to the banks. Our firm uses, there's a spreadsheet that the American Institute of Certified Public Accountants has come out with. It's very helpful for tracking the costs. It's in Excel format. If you were interested in looking at any of those spreadsheets, I'd be glad to email those to you at some point in the near future.
And Tony, this is Val. I don't mean to interrupt you. I have 2 questions, and I'm not sure if it's the appropriate place to ask them, but they are about payroll. And so I thought maybe we could just take a pause and
Sure.
those 2 questions. Great. In regard to FTE calculation, how does that work if the period changes from 8 to 24 weeks?
Yes. Yep. So for the full-time equivalents, it has to be people that work 40 hours per week. It would be considered a full-time equivalent. And then if you have part-time people, like for example, add 2 people together to get to the 40 hours, and they would be 1 full-time equivalent. So actually I have a slide a little bit later that will go through the exact calculation. So
Okay.
yeah, I'll address that in that slide, but definitely a good question.
Great, thanks. Sorry to I didn't mean to go out of order there. I didn't know if you saw the question in the chat feature, if that's an appropriate one there. It's kind of a 3-parter, just in terms of limits on wages to owner employees and related parties. So whether it's a spouse, child, the grandchildren, and how excess payments to owners count toward the percentage spend. Do the excess payments to owners count toward the percentage spend for wages? So if now is a good time to address that or later, just wanted to make sure you saw that one.
Okay, no, thank you. No, very good question. So any payments to related parties would still qualify. I think the government recognized that so many businesses are family owned, and there's obviously related people that work there. So there's no restriction in terms of if your spouse or children are on the payroll, as long as they're performing a legitimate function, that would definitely qualify. There is a cap, so that if someone earned compensation in excess of $100,000, Anything over that would not count. So, if they were capped out and had already earned that amount during the year, any excess would not qualify for the payroll cost. So there is a restriction in terms of higher income people that have a higher compensation. Okay, so I will, there is a slide on the full-time equivalent, so that, good question. I'll address that because I actually have a kind of a detailed calculation I think will explain that hopefully pretty well.
Great, thanks.
In terms of the accounting for your PPP loan, ideally what you would want to do, and hopefully a lot of you have done this, is if you were able to open a separate bank account to specifically account for the PPP loan funds, that would be probably the cleanest thing to do. Or if you happen to have a dormant or a seldom used bank account, you could repurpose it for that purpose. The key is to keep the funds outside of your normal checking account and operating funds so that you can easily trace and document where each dollar was spent. So that would really be the ideal situation. There may be cases where maybe some of you didn't create a separate account or have everything allocated to a separate account. And what I'm going to talk about is the best way to track it in that situation. Biggest thing from an accounting software standpoint is to turn on what's referred to as class tracking. That's the terminology that QuickBooks uses. And what this does, it allows your bookkeeper to code certain transactions as PPP loan funds. They then will be able to run a report that includes those PPP funds in a separate column, essentially stripping out those figures from the others on your profit and loss statement. So what the class tracking will do is you'll run a profit and loss statement, and it'll have different columns. It may have one that's set up for your wine sales, another one for your grape sales, and then there'll be another column that'll be entitled PPP loan funds, and that'll break out expenses such as payroll, mortgage interest that are specifically allocated to the use of the PPP loan funds. And that's something that's going to be helpful at the end of the measurement period to track what was actually spent. So again, if you were able to put everything in a separate bank account, that would be ideal. If not, there are some workarounds, and certainly having a good handle on class tracking within the accounting software would work well. If you use a program other than QuickBooks, there are comparable features. If you use Sage 50, for example, there's a comparable feature that can be used. From an accounting standpoint, you want to set up 2 new accounts on your books. One is a current liability account. That's called the Paycheck Protection Program loan. The other is an extraordinary income account. I would have the description non-taxable. So it's an other income account. And the reason I would have it listed as non-taxable is that when it comes time to prepare your tax returns for 2020, you want it clearly delineated that those funds are not subject to income tax. And just as a reminder to your tax return preparer. Okay, so when you receive the deposit in your PPP loan and the proceeds go into your account, code that deposit to your PPP loan account. So there currently should be a current liability reflecting the loan balance on your balance sheet. As you spend the funds for the intended purpose, you want to expense them as normal. So you would have your normal payroll costs, your mortgage interest, your rent expense, because remember, your PPP loan at this time remains unchanged. It's still a loan or a liability on your balance sheet. Once you apply for forgiveness, move the amount forgiven from the PPP loan account to the extraordinary income account. So once you've received approval that the loan is forgiven, it comes off your balance sheet. It's no longer a liability. It becomes an other non-taxable grant account on your income statement. Very important that you document proof in order to have forgivability of the loan. You'll want copies of payroll tax reports filed with the IRS, forms 941, 940, state income tax and unemployment tax filing reports for the 8-week period. In some cases now it could be 24 weeks if you elect that. Copies of payroll reports for each period for the 8-week or 24-week period following the origination of the loan. Documentation reflecting health insurance premiums paid by the winery under a group health plan, including the owners of the company for the 8 or 24-week period following the origination of the loan. As far as the health insurance, the copies of the monthly invoices should be sufficient documentation. You'll want documentation of all retirement plan funding by the employer for the time frame following the origination of the loan. Copies of work papers, schedules, or remittances to the retirement plan administrator should be made available if necessary. You'll also want copies of all lease agreements for real estate and tangible personal property, and they should be presented along with proof of payment during the time frame, starting with the loan origination. You'll want copies of all statements of interest paid on debt obligations issued prior to February 15th, 2020, including payment amounts and proof of payment for the 8-week period following the loan's origination date. You'll also want copies of canceled checks, statements, or other evidence, could be bank statements for utility payments during the covered period following the loan origination. Last couple slides are the loan forgiveness calculation process. These were actually outlined by the American Institute of CPAs. They provided guidance in this area. So once you have a good handle on what your costs were and what you spent, calculate your payroll costs for forgiveness. So it had been that 75% of eligible costs were to be used for payroll. You can substitute 60% now. If less than that threshold, the forgiveness is reduced by the amount under the 75%. Again, the one change with the new legislation is now the threshold is 60%, but if you don't meet that 60% threshold, then the entire loan stays just a loan and is not forgiven. With regard to I know there's a question on the full-time equivalents. So you calculate any decrease in full-time equivalent employees from the 8-week covered period. For example, a 15% drop in full-time equivalents results in a 15% decrease in the amount of the loan forgiven. And the question was, how does that change with regard to the 24-week period? And essentially it would be the same thing, except in this step 2, you would just substitute 24 weeks for the 8-week time frame. So that one of the main purposes of this program is that it encourages companies to maintain a certain level of payroll. So you want to make sure that your full-time equivalents are not dropping below that initial measurement period in the measurement date, and it would just extend out to 24 weeks instead of 8 weeks. But it's essentially the same calculation, just a different time frame. Step 3, calculate any reduction in payroll of greater than 25% for the prior quarter. So for any employee who did not receive during any single pay period during 2019, wages and salary at an annualized rate of pay of more than $100,000, and also employees whose primary residence was outside of the US. And then the question is, was their payroll during the covered period more than 25% less than it was in the previous quarter? If yes, then you would reduce the amount by the reduction that exceeds 25%. And there are spreadsheets that can kind of help you with this calculation. And again, I'd be happy to forward those as hopefully a useful tool. The last step is calculate any adjustment because the full-time equivalents and salary wages were restored by June 30th. So what this last step does is it kind of gives you a grace period, or kind of like almost like a get out of jail free card, where if your full-time equivalents and your payroll costs drop below the thresholds, if you restore them, if you stayed with the 8-week period, you'd have to restore them by June 30th. Then you'd meet the forgiveness criteria. If you elected the 24-week time frame, then you would have until the end of the year to bring your payroll in terms of cost and in terms of full-time equivalents up to the thresholds where you could still get the forgiveness. A little bit complicated. There's a lot of different moving parts, but I think a lot of the spreadsheets and tools that are out there are helpful in terms of working through these calculations. As I mentioned, there was legislation passed today. The House had passed the legislation last Thursday. The Senate approved the legislation today, and it's expected that the President would sign it. Just very quickly, and I'd be glad to send this briefing. The main highlights are that the PPP borrowers can choose to extend the 8-week period to 24 weeks, or they can keep the original 8-week period. This flexibility is designed to make it easier for borrowers to reach the full or almost full forgiveness. And then borrowers can use the 24-week period to restore their workforces and wages to the pre-pandemic levels required for full forgiveness. This must be done by December 31st, a change from the previous deadline of June 30th. If any portion of the loan is not forgiven, it becomes a loan at a 1% interest rate. And it had been a 2-year loan, but under the new provisions that were just passed, borrowers would now have 5 years to repay the loan instead of 2 years. So some pretty significant changes, and definitely a recent development that was just hot off the press. But be glad to address any questions either now or via email, and be glad to also send this update briefing to Val for her to pass along.
Thanks, Tony. Yeah, we would really appreciate those tools. I think they'll be very helpful for people. And we will certainly send along the recording too, so that people can go back and listen to your guidance as they walk through these steps. I don't know, I would like you, just Tony, if you could direct your attention to the question that remains in the chat bar, and certainly we have kind of a minute or two left. If people do have other questions, we'd be happy to take them. I don't know if did we specifically address, I'm sorry if we did and I missed it, the questions about the limits on wages to owner employees, and whether is a question about what's forgivable or if that's allowable. I don't know if the questioner wants to weigh in on whether their question was answered, but I just wanted to make sure we address that.
Sure. No, very, very good question. So, like for example, if you had a winery that operated as a partnership or an S corporation, those salaries would still count toward the meeting the payroll tests in terms of loan forgiveness. So they would still count as well.
Okay.
Great. Yeah, I would just add to that too. A lot of times business owners, like particularly in the context of an S corporation, may wait till the end of the year to pay themselves a salary to see how the year plays out. This might be one circumstance where it might make sense to accelerate some payments to the owner just to make sure that those payroll threshold.
Right. I don't know if you saw the additional clarification that came in into the chat feature, about the not answered about the 850. I don't know. 8 weeks 52. I don't know if that's 852 limit. Sorry.
Okay. So yes, under the old legislation, from the origination and the receipt of the loan proceeds, you'd have 8 weeks going forward to meet all these thresholds in terms of maintaining the level of payroll cost and also the full-time equivalents. And so with the 24-week option now, it just gives you a longer time frame to make those thresholds. So it's really meant to be very favorable to the loan recipients in terms of giving them more time, because there was some concern that a lot of people had that they wouldn't be able to fully use the loan proceeds in a relatively short time frame of 8 weeks. Worst case scenario, if you didn't use all the proceeds for the intended purposes, it would become a relatively low interest rate loan at 1%.
Right.
Payable now over 5 years. So it's still not a bad deal.
Well, great, thanks. And if we still haven't answered the question fully, here's Tony's contact information for some follow-up, whether you want to give him a call or send him an email. He'd be happy to connect with you after the webinar is over. So thank you, everybody, for joining us today. And Tony, thank you so much for providing this information. It is complex and challenging, and thanks for helping us kind of make the most of it and make some sense out of it today. We appreciate it. And thanks for the update so quickly after it was announced. We appreciate that too.
Oh, you're very welcome. And thank you for the opportunity today. Really appreciate it.
Great. Thanks, everybody. Have a good day. Take care.